Hey there, future Wall Street titans. Ever wonder how some people just seem to have a knack for picking winning stocks? It's not magic, folks, it's equity securities analysis. And trust me, it's a game changer. This is your backstage pass to understanding the financial markets and making those savvy investment decisions. Think of it as financial detective work, but with potentially huge rewards. In today's fast-paced market, knowledge is power. So whether you're a seasoned investor or just starting out, buckle up. We're about to embark on an exciting journey into the world of equity securities analysis. Remember, fortune favors the bold, but it rewards the informed. All right, let's break down the two main approaches to equity securities analysis: fundamental analysis and technical analysis. Fundamental analysis is all about understanding the intrinsic value of a company. We're talking about digging into their financials, their management team, their competitive landscape, the whole shebang. Technical analysis, on the other hand, is more about reading the market's mind. We look for patterns and trends in price charts and trading volume to predict future price movements. Some investors swear by fundamental analysis, while others live and breathe technical analysis. But the truth is, they both have their strengths and weaknesses. Ultimately, the key is to find what works best for you and stick with it. All right, let's dive into the exciting world of fundamental analysis, starting with the bottom-up approach. This method is all about getting granular, folks. We're talking about rolling up our sleeves and digging deep into the nitty-gritty of individual companies. We start by examining a company's financial statements, their DNA, if you will. The goal is to determine a company's intrinsic value, their true worth, beyond the hype and market noise. It's about finding those diamonds in the rough, those stocks that can supercharge your portfolio. Now, let's shift gears and explore the top-down approach to fundamental analysis. This method takes a broader perspective, starting with the big picture, the overall economy. We consider factors like GDP growth, inflation, interest rates, and unemployment. Once we have a handle on the macro environment, we zoom in on specific industries. Finally, we narrow our focus to individual companies within those industries. The goal is to identify the strongest players in the most promising industries, those best positioned to capitalize on favorable economic tailwinds. Now, let's delve deeper into the concept of intrinsic value, the holy grail of fundamental analysis. Intrinsic value represents the true worth of a company based on its future earnings potential, its assets, and its cash flow generation. To estimate intrinsic value, analysts use a variety of valuation models, such as a discounted cash flow or DCF analysis. The goal of intrinsic value analysis is to identify companies trading at a discount to their intrinsic value. Think of it as finding hidden treasures in the bargain bin. All right, folks, let's talk about the economy. Understanding the economic landscape is like having a crystal ball for the stock market. Think of it this way: the economy is like the ocean, and individual companies are like ships sailing on it. A strong, growing economy is like calm seas and favorable winds propelling those ships forward. But a weak or contracting economy is like stormy weather, tossing those ships around and making it tough to stay afloat. As savvy investors, we need to be economic weather forecasters. See how it all connects? Now, let's decode some of the economic jargon you'll hear thrown around. First up, GDP, or gross domestic product. Think of GDP as the economy's report card. Next, we have inflation, the rate at which prices for goods and services are rising. Another key indicator is the unemployment rate, which measures the percentage of the labor force that is unemployed and actively seeking work. And finally, we have interest rates, the cost of borrowing money. Now let's talk about the big players influencing the economy, the Federal Reserve and the government. The Fed acts like the economy's conductor, using monetary policy to control the money supply and interest rates. The Fed has several tools in its monetary policy toolbox. The government also plays a crucial role in steering the economy through fiscal policy. For example, increasing government spending on infrastructure projects can create jobs and stimulate economic growth. However, excessive spending or tax cuts can lead to inflation and government debt, so it's a delicate balancing act. All right, folks, let's talk about business cycles, the natural ebb and flow of economic activity. We've got expansions, those exhilarating climbs uphill when the economy is booming, jobs are plentiful and businesses are thriving. Then come contractions, those stomach-churning drops when the economy slows down, businesses tighten their belts and unemployment rises. Now, why should investors care about these economic mood swings? Because different industries perform differently depending on where we are in the business cycle. For example, during expansions, consumer discretionary stocks like those in the retail or entertainment industries tend to outperform. So, by understanding business cycles, we can make smarter investment decisions, shifting our portfolio allocations based on the economic climate. Now let's zoom in on specific industries and explore the concept of industry life cycles. Just like living organisms, industries go through distinct stages of growth and development. Take the internet, for example. In the early days, it was a nascent industry, full of promise and potential. But as industries mature, growth slows down, competition heats up, profit margins shrink, and it becomes harder to generate those outsized returns. Finally, industries can enter decline as new innovations emerge or consumer preferences shift. Remember Blockbuster Video? They were once a giant in the movie rental industry, but they failed to adapt to the rise of streaming services like Netflix. Understanding industry life cycles helps us identify those industries with the greatest growth potential and avoid those on the decline. Now let's talk about competition. In the business world, it's a jungle out there. Companies are constantly battling for market share. Enter Michael Porter, a Harvard Business School professor who developed a framework for analyzing industry competition, Porter's 5 Forces. This framework helps us assess the attractiveness of an industry by examining the power dynamics between different players. First, we've got the threat of new entrants. How easy is it for new companies to enter the market and shake things up? Then, we've got the bargaining power of suppliers. How much leverage do suppliers have over the companies in the industry? All right, folks, it's time to roll up our sleeves and dive into the heart of company analysis financial statements. We've got 3 primary financial statements to examine: the income statement, the balance sheet, and the statement of cash flows. The income statement shows us how much revenue a company generated over a period of time, their expenses, and their net income or profit. The balance sheet provides a snapshot of a company's financial position at a specific point in time. And lastly, we have the statement of cash flows, which tracks the movement of cash both in and out of a company. Cash flow is king in the business world, and this statement helps us understand a company's liquidity, their ability to meet their financial obligations. Let's take our financial analysis to the next level with ratio analysis. Ratios are like financial magnifying glasses, zooming in on specific aspects of a company's performance. It's like comparing apples to apples, oranges to oranges, several categories of ratios to consider. Liquidity ratios measure a company's ability to meet short-term obligations. Think of it as their financial stamina. A healthy current ratio is generally 2 to 1 or higher. Asset management ratios assess how efficiently a company uses its assets. We want companies using their assets wisely. A high inventory turnover ratio indicates quick inventory sales. Financial leverage ratios tell us how much debt a company uses. Debt can amplify returns but also increase risk. We want to ensure a company isn't overly reliant on debt. Now, let's dissect profitability, the lifeblood of any successful company. The DuPont formula breaks down return on equity into net profit margin, asset turnover, and financial leverage. Net profit margin measures profit per dollar of revenue. Asset turnover shows revenue generated from assets. Financial leverage indicates debt usage. Together, these drive overall profitability. All right, chart enthusiasts. Technical analysis is your domain. Forget digging through financial statements. We're all about those squiggly lines and candlestick patterns here. We're like treasure hunters looking for hidden messages in the historical price movements of stocks. It's like deciphering an ancient map that leads to potential trading profits. Technical analysts believe that history repeats itself, at least in the market. We use charts to identify trends, patterns, and signals that suggest where a stock price might be headed. It's like watching a replay of a football game, looking for tendencies and formations that might give us an edge. One of our most powerful tools is the candlestick chart. Each candlestick tells a story about a particular trading day, the open price, the close price, the high and the low. Are those candlesticks long and green indicating bullish sentiment, or are they short and red, signaling bearish pressure? We also look for support and resistance levels, like invisible barriers that a stock price seems to bounce off of. Breakouts above resistance can signal a bullish move, while breakdowns below support might indicate further declines. It's like watching a tennis match, seeing if a player can break their opponent's serve. Now let's talk about volume, baby. Volume is the fuel that propels stock prices. It measures the number of shares traded over a specific period. High volume confirms trends. Low volume suggests waning interest. Think of it like a crowded stadium versus an empty one. Volume spikes with price breakouts indicate conviction. It's like a surfer catching a big wave. Low volume during a price move might signal a false breakout. Momentum indicators like RSI and MACD gauge trend strength. They measure the speed and magnitude of price changes. A high RSI suggests a stock is overbought. A low RSI indicates a stock is oversold. Technical analysts have a whole arsenal of indicators at their disposal, each providing a unique perspective on market sentiment and potential price movements. Moving averages, for example, help smooth out price fluctuations and identify trends. We can use different time periods for moving averages like 50-day or 200-day averages to capture short-term and long-term trends. Bollinger Bands, developed by John Bollinger, are like dynamic support and resistance levels that adjust to market volatility. They consist of a middle band, which is a moving average, and two outer bands, which are typically two standard deviations away from the middle band. Prices tend to stay within the Bollinger Bands, and breakouts above or below the bands can signal significant moves. Fibonacci retracement levels, based on the Fibonacci sequence, are another popular tool for identifying potential support and resistance levels. These levels are calculated based on the percentage retracements of a previous price move. Common Fibonacci retracement levels include 23.6%, 38.2%, 50%, 61.8%, and 100%. Technical analysis is like learning a new language. It takes time, practice, and experience to master. But once you understand the basics of charting, volume analysis, and technical indicators, you'll be well on your way to deciphering the market's whispers and potentially profiting from its movements. So there you have it, folks. We've journeyed through equity securities analysis from fundamental to technical analysis. We've learned to decipher financial statements and analyze economic trends. We've dipped our toes into technical indicators and charting patterns. Remember, knowledge is power in investing. By understanding stocks, you're taking control of your financial future. You're no longer at the mercy of market whims. You're becoming an informed investor equipped to make smarter decisions. Remember, investing is a journey, not a destination. It's about continuous learning, adapting to new information, and refining your strategies over time. As you gain experience, you'll develop your own investment style, your own risk tolerance, and your own preferred analysis methods. Maybe you'll become a die-hard fundamentalist, poring over financial statements with the zeal of a forensic accountant. Or perhaps you'll embrace the world of technical analysis, spotting chart patterns with the precision of a seasoned cartographer. The key is to find what works best for you, to build a system that you trust and that aligns with your investment goals. Don't be afraid to experiment, to try different approaches, and to learn from your mistakes. Remember, even the most successful investors have experienced their share of setbacks along the way. It's all part of the learning process. As you embark on this exciting journey, remember to stay curious, stay disciplined, and stay focused on your long-term goals. The market may test your patience, it may throw curveballs your way, But with knowledge and perseverance, you'll be well equipped to navigate the market maze. So go forth, fellow investors, armed with the power of equity securities analysis. May your portfolios prosper, your returns soar, and your financial dreams become a reality. And remember, the best time to start investing is always today.